Investing is really difficult. And one of the main reasons why is we will oftentimes confuse performance with being right and underperformance with being wrong. As an example, going back to '04 until 2019 or so, I had outperformed the market over that period of time by a few percentage points. But my lagging over the last 3 or 4 years has caused me to lose that edge. So if you compared me over the last 3 or 4 years to other times, you say, this guy's a bad investor. But you go over long periods of time and I crush. And I absolutely feel confident that over the next 60 years of my life, I will at least outperform the market by a few percentage points per year. Why is that? Because of process. However, I look back at my history of investing, and there are times in which I had a favorable outcome, but my process was wrong. So a lot of people out there, probably 95% of people out there would probably say, well, the outcome ended up doing what you wanted to do. You were right. That is incorrect. That is absolutely incorrect. Let me give the example. Back in 2013, Facebook went public. And it started, I think, I don't remember exactly where it started, but I thought it was overvalued. Now, this was before I changed my viewpoint of valuation to more of a long-term model of looking at revenue growth, profit growth, and balance sheets. I looked purely at where the company was today based on where other companies should be in history. That has changed a lot for me as an investor over the last 10 or 12 years. The stock was selling around $32 or $33 a share. I shorted Facebook saying it was overpriced. And guess what? It plummeted down to 18. I exited around 22 or 23, and I was going like this. I'm like, look, I'm a genius. The first stock I ever shorted, and I was right. But now I look back on it, and I was 100% wrong in my evaluation of Facebook. I just got lucky that the stock tanked at that point. Do you see what I'm saying here? So the outcome was correct, but my process was incorrect. I did not properly evaluate Facebook based on its growth potential in the future. I just got lucky that over a short period of time, it fell. Amazon. I shorted Amazon at $300 a share many years ago. It immediately went down to $218 or $220. I kept on my short because I thought it was a $50 stock at most, and it went straight up from there. So at the beginning, I could have exited just like I did with Facebook and said, look, I was right. But remember, it's not about what happens in the short run. It's about what happens in the long run. And part of being a good investor is looking back at the things that didn't work out the way you expected and learning from it, and also the things that did work out as you expected. But if your process was wrong, that is equally as bad, because a long-term process that's wrong will cost you more in the long run than the right process with the bad outcome. In The Psychology of Money, this is a phenomenal book. I encourage everybody to read it before they go any further investing. Morgan Housel talks about something very, very smart. He says, listen, there are chances, there's no 100% guarantee. And even if something is stacked 80% in your favor, you're still going to be wrong 20% of the time, right? It's still going to work. There's still outliers out there that are going to happen that you go, oh, I didn't factor that in there. And you could still be wrong. In the Facebook example, I think I was supposed to be wrong 80% of the time. And I just happened to catch the 20% where I was right. And it actually cost me in the long run because it gave me some irrational confidence in my ability to short. I said, hey, listen, overvalued stock, I shorted, it went down, I won. And I went and did more, and I ended up being wrong on Amazon. Why? For the same reason. The difference with the Amazon short is my process was wrong, my evaluation was wrong, and the market proved me to be wrong. Now, do I still think Amazon is overpriced? Absolutely. And remember, when I say $200, $300 a share on Amazon, they recently split. So this is before their split. I believe in process. And I also believe that over long periods of time, process is what's going to dictate your long-term results. That is why I'm very confident saying that, hey, the last 3 or 4 or 5 years hasn't been the best for me, but I'll still outperform in the long haul. I will still do better. Why? Because I believe my process does work. And it took one of the most extreme, actually the most extreme market in history to tell me that, hey, things can get crazier than even you expect. And that was a great learning lesson. It also allowed me to figure out a way to use options to make money in the long run. That will also help me get an even bigger return above and beyond my market outperformance. So I want everybody to remember that when you look at your results or anybody's results, don't pull the one item that makes you say, hey, this was correct. Look at the overall. When you're looking at people who manage money, I hear it all the time. Paul, in the last 5 years, I'm up, blah, blah, blah. I say, I don't care. Show me how you did during a full bull and bear market cycle. I want to see the full thing, because a real good investor isn't only going to do well during good times. In fact, they'll probably do worse during good times, but during the bad times is when they'll really shine. Not necessarily outperforming, but buying really, really good companies at much better prices. And that's what I learned the most from my Facebook incident. That even though the outcome showed people that I was correct, it didn't prove to everybody that I was correct. It just proved that sometimes things do work out the way you want to, but with the wrong process. If I sit at the plate and wait for pitches and I close my eyes, if I swing enough pitches, eventually I'll hit a pitch. That doesn't make me a good hitter. And guess what? If we did it with 10,000 people, a few of those people would swing and hit on the very first pitch. That doesn't make them a good baseball player. What I would ask them to do is take 100 pitches like that. How do you do? That is what matters. It's the long run that matters. It is looking at the process and how it gets applied to the long run to see, are you a good investor or not? I got duped by my own inability to sit there and say, is it possible that I was correct, but for the wrong reasons? Because that can be more damaging sometimes than being wrong for the wrong reasons, okay? I look at it saying, okay, I've learned from all of these, and I've learned that when I have a process that is smart and expanded on several different assets or several different securities, over the long run, I will probably do pretty well, and that is my goal. So how does that apply to today? Well, you guys have watched our videos, over 1,700 videos in the last 2 or 3 years, and I criticized a lot of stocks. But now that certain stocks have fallen 70, 80, 90%, I now have to sit there and take my bias against those stocks from the past and realize this is a new investment with a new valuation. How do I apply this to the future? Don't attach yourself to a certain investment or security and say, okay, this fell a lot. You now have to take yourself out of it and say, how would I evaluate this company from here? That is the important part. So I am taking a look at companies now that before I criticize. Now, the good news is most of them by and far still don't have the ability to justify their investment. But I will be open with you. The one that's causing the most intrigue for me is Palantir. This is the incredible part, because I heavily criticized Palantir at $40 a share. I heavily criticized that one guy on the channel out there who kept talking about Palantir as the future. But now I look at Palantir at $7 or $8 a share and I say, okay, it's still losing money, but what is the growth potential for this company? Because it's in a very, very impressive software business founded by a very, very, very smart man that I respect a lot. So I look at Palantir and say, okay, Paul, take your bias. Yes, I do think my idea about Palantir was correct. At $40 a share, it could not justify at that time, and it might have taken a while to come down. Luckily, it was near the peak of this hype stock mania, and it plummeted very quickly, 80%. So now I look at it and say, okay, the process worked before. Your evaluation was right, and the result ended up being correct. Now, look at the company completely from a different standpoint. At $7 or $8 a share, what does the company need to do to justify that to get an outsized return to the market? Once I look at that, then I can sit there and apply the same process that I used to determine it was overpriced at 40 to see, is it underpriced at 7 or 8? And I might sit there and say, you know what? It could be a good deal, but it's too hard for me to understand, so I'm going to pass on it. But it could very well be a good deal. I think it's very interesting at $7 or $8 a share to do more research on it because it's growing fast. They do an incredible job. They have a lot of great government contracts, and they've expanded very well into the commercial B2B area. So this is a very interesting company to me. So the one thing I ask from you, you need to subscribe to this channel, because even though my other videos where I'm very bombastic about things in the market, I'm here to evaluate the markets on where they stand today. And I will reevaluate based on where prices go, because I believe that price and value are very different. And I want to buy when value is greater than price by a large enough margin of safety that it makes sense to me to buy. So if that makes sense to you, you need to subscribe to this channel. And I guarantee you, if you watch 4 or 5 other videos of ours, you will walk away having a better understanding of money and investing. And even if you don't agree with me, you'll say, wait, this guy has a pretty good process long-term. Thank you very much for your time. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.